Muddy Waters, noted short seller in the past month, has put out two reports about SoFi, claiming that you're looking at a company that is engaging in financial engineering. It's a treadmill, leaving management fat. Shareholders are the biggest losers, suggesting that they've overstated profitability to the tune of $1 billion. This was from a report first in March 17th, so earlier this month. Management responded effectively saying, yeah, we're going to explore potential legal action. You're doing this report to erode shareholder value, from a stock price decline. You really don't understand the business. That was the response. And then the CEO said, yeah, as if legal action wasn't enough. I'm a buyer. Thank you for causing the stock price to dip. I'm going to buy another $500,000 worth of SoFi stock. That's what CEO Anthony Noto did following that short report. So what Muddy Waters do? They responded just this past weekend saying, look, here's part two. We have 11 questions. We've gotten 0 answers. We started with a pseudonymous engagement to try to, understand this. Yes, we didn't use our name because if we said, hey, we're a noted short seller, you might not engage. But we asked these questions. We ultimately did talk to investor relations, but, the investor relations team showed, demonstrated sensitivity to questions about fair value gain accounting and its secured loan program, and investor relations refused to engage with us. So effectively, management's closing them off. Management can close them off. They don't have an obligation where they have to answer all the shareholder questions. I mean, you look at someone like Berkshire Hathaway, they have one annual meeting a year for shareholder questions. So I think it is important to recognize management doesn't have to. It's bonus if they do. But I do think it is important to call out a key point here is that management, instead of rebutting each of the criticisms, each of the suggestions, the warnings, this potential smoking gun signs from Muddy Waters, they effectively said, hey, you don't understand the business. We're going to potentially sue you. You're in the business of causing the share price to go lower. I don't care for that response. I prefer a here's why you're wrong type of response. But even if management doesn't want to do it, I understand. I'm not going to fully fault them. I prefer to be able to walk through it. And this video is my takeaway that actually Muddy Waters is calling out several things that I think bulls investors in the stock. I don't have a position in it, neither long nor short. I don't really short. And so I look at this and I'm saying, if I were long SoFi, I would want to read that report. It's worth digging through. And overall, when I look at, short sellers, I'm actually generally grateful for them, because when you have a short seller say, here's the best case I can make for why the stock price is going lower. If you as a shareholder can go point by point through it and go, yeah, this isn't a smoking gun. These are some noises you picked up, but overall zooming out, it's really not that significant. And I've actually called out a different short report with Muddy Waters where I said, yeah, this is muddy thinking. And I bought more based on the Muddy Waters dip, and it worked out quite well. So it is important to recognize short sellers do have a value in the ecosystem, in my opinion, which is that they're steel manning the argument. They're effectively giving you, here's all the reasons why this stock might not work out. And if you can go one by one and say, yeah, I disagree, and here's why, that's a very strong position to be in. Charlie Munger, the famous billionaire investor, rest in peace, he sort of made the exact comment, which is that he wants to, if he's going to buy any shares, he wants to be able to make the counter argument better than anyone else on why you shouldn't own the shares. And so that's, I'd argue, the value of a short seller. So I'm glad when a short seller is going to air it out, saying, here's the top problems. And frankly, as I've already suggested, the problems that they're calling out are significant, suggesting a potential misstatement in their balance sheet, potentially significantly higher charge-off rates in their reporting, which would also hurt their profitability, and also using aggressive discount rate assumptions. And I think it is important to recognize when you're looking at a company like SoFi, effectively a lender. Now, they do push off some of the loans off to other third-party investors, but when you do keep a lot of loans on your own investment book, billions of dollars of loans, where you mark those loans because you made the loans will impact the profitability that you show. If you say, hey, this loan should be 106 cents on the dollar, this loan's 100 cents on the dollar, that difference can be significant over billions of dollars. So you really need to be able to back up the discount rates you're using for your loans with, I'd argue, a lot of detail and arguably a conservative picture. That would be ideal, saying, hey, I'm going to value my loans at 98 cents when there's clear precedent that it should be over 100 cents. That is the sort of management thinking, that conservative culture that I like to see. I'd argue there are signs that you're seeing the opposite here with SoFi. So let's go through it. Let's go through some of these claims. So first of all, one of the key ones that Muddy Waters calls out is that there's really this surprising difference between their charge-offs versus their loans past due. And, the way to think about that is that if you have X dollars of 30 plus day delinquent loans at quarter end, and then you charge off more than X dollars the next quarter, the excess must be coming from somewhere. It's either current loans at quarter end deteriorated rapidly, or they were transferred off balance sheet before SoFi, but SoFi still services them. So I think it is important to recognize this dynamic, is that typically when you have a loan, and in this case, SoFi services literally billions of dollars of personal loans, these consumer loans, you're going to have some bad credits, some effectively some borrowers that can't pay it. And so you're going to see it in the 30 days past due. However, if you look at, what's going on here, the reported charge-offs are then higher. Usually the past due is sort of the ceiling for what the charge-offs can be the next quarter. So it is very weird to see this dynamic. Now, management does explain that part of it is because they're aggressively trying to sell their loans. But in my opinion, SoFi appears to be moving its worst loans off the book right before they'd count as defaults, which makes its loan portfolio look healthier than it really is. Now, this suggests only about a 5% default rate versus a default rate closer to, let's say, 6.5% that Muddy Waters thinks. So this is sort of one of the red flags. In my opinion, it does get into a bit of, he said, she said. At the end of the day, management is going to have more information, but it is weird to see that charge-off rate, higher than the 30-day delinquency. Just typically with banks, you see X% 30-day delinquency and then a lower percent charge-offs where you're saying, hey, I'm wiping this off. And so what's also sort of weird, and you could say, well, they have aggressive policies to sell these loans. What's also sort of weird is noting that the fair value of the discount rate has gone from around 4.55% this past year to 4.46%. Okay? So effectively, SoFi is saying the discount rate for their consumer loans has actually dropped a little bit. And at the same time, independent rating agencies like Fitch and Morningstar are assuming default rates that are getting worse with newer consumer loan vintages. So that's literally going back and forth. The default rate that SoFi is assuming, this first green bar at the top, is getting better, whereas independent rating agencies, which, as folks know, it's not like they're necessarily the, sharpest tool in the box, didn't necessarily catch the great financial crisis. And here it is. They're saying, look, the default rates we're assuming are progressively getting worse. So it's something to note. You could say, once again, he said, she said, management views this. So do you trust management? That's I think what it comes down to. Now, another one of Muddy Waters' key claims is that SoFi misstated their balance sheet potentially by hundreds of millions of dollars. In one instance, the CFO told investors on an earnings call that SoFi had sold $312 million of loans. You can look that up. That's, I believe, from the third or fourth quarter of 2024. But a public legal filing says SoFi's own subsidiary borrowed that money from JP Morgan using those same loans as collateral. So was it actually a sale, or is SoFi borrowing money, moving it to another pocket, and the borrowed money isn't showing up on the balance sheet? This is another example of, okay, do you trust management? Because this is just weird. It's weird, that Muddy Waters is finding this and suggesting, wait a second, you didn't actually sell this $312 million. I personally would love to understand this in greater detail if they could just be like, hey, you're wrong, Muddy Waters, and here's why. Doesn't even have to be super, super long, but just some sort of clarification. So is there a smoking gun as I look at SoFi stock as you're thinking about it? First of all, none of this is financial advice, just looking at one short seller analyzing SoFi stock. And quick plug about Unrivaled Investing. Doug S., a premium member, wrote, I've been a member only 3 months and I'm overwhelmed by how good your service is. This follows Brandon M., who wrote, thank you so much for calling this out to me a few months ago. Unrivaled Investing, I'm up $72,000, and he talks about a particular company. If you enjoy this video, I do make exclusive videos just for my subscribers at Unrivaled Investing. If you're looking for compelling ideas, real-time portfolio updates, and insights, come check it out. And so overall, I'm actually a big fan of seeing management buy stock. I love that. Management alignment is super important. So when I see Anthony Noto buy $1 million, $500,000, buying stock in SoFi, I view that as a very favorable development. I actually love to see all insider buying, and now Flash has a Sentinel. Flash is my AI-powered assistant looking at companies around the world. There's now a premium feature called Insider IQ, so that way subscribers at Flash can look at all these insider buys, get the reports on the companies, making it super easy to research companies. So if you're interested in looking for those insider buys around the world, come check that out, along with the analysis that goes with it. That and, the free reports on any company in the world, that's at Flash. Once again, leveraging AI to help empower my own investment journey and hopefully yours too. Once again, it's free to use. The premium features like Insider IQ aren't, but you can check that out yourself. So I think it's also important when you look at all the different parties to understand Muddy Waters' position. Where are they potentially benefiting? And, it's very clear. In their disclaimer in their report, they write, upon publication, we intend to begin covering a substantial majority, possibly all of our short positions. As we elaborate below, our risk reduction is not a reflection of a lack of conviction in our opinions or the facts presented. Rather, it has to do with managing risk in a manner that is prudent, blah, blah, blah. What they're saying is, hey, we noticed that once we put out this short report, well, it turns out the stock can go down and we have this nice short position and we'd like to cover it without getting sued. So let's just have this disclaimer up front that we're going to cover. I don't care for that dynamic, which is like, hey, once this is published, the stock's going to go down 10, 20%, and then we're going to cover, and it's a nice way to juice our portfolio and generate some returns. That's the part of short selling that I really don't like. So I think investors should understand that Muddy Waters is effectively saying, hey, immediately upon publication, we're going to do this. I think a more honorable approach would be to say, hey, we have such conviction in our thesis that in a month from now, we're going to cover. We're not going to react immediately to what might be a short-term supply-demand aspect where because we put out this report, there's a lot more sellers because they're like, what's going on? Is there actually a smoking gun? They haven't done the research. And then Muddy Waters is like, thank you very much. I think the honorable decision is to say, hey, within 30 days, 60 days, have some sort of clear window that, in my opinion, that shows you actually do have conviction. You're not just manipulating the stock. So I think that is important to reflect on. So I don't care for that. That, in my opinion, muddies their own thesis. This is the part that bothers me, though. Everything up until this point, you could argue Muddy Waters has an interpretation, management has an interpretation. Well, Muddy Waters doesn't have perfect information, so you should probably go with management. Muddy Waters is sort of looking at different data points. Maybe they're misreading something. Maybe they're just wrong. I mean, what I've talked about so far is, to be honest, very relevant. Management is Muddy Waters effectively saying, hey, your default rates are actually way worse than you're suggesting. And by the way, you borrowed arguably hundreds of millions of dollars from JP Morgan, and you're not showing that on your balance sheet. Those are red flags if it's true. It's hard to prove that, though. If Muddy Waters is right, that would result in a financial restatement for SoFi. So it is important to recognize that they've done a lot of sleuthing here. I just don't know how accurate they are. It's interesting. These are good questions, and I would want answers to them. If management were inclined to do so. If I certainly were a shareholder, I'd want to have an opinion about these dynamics, something to think about. But the third point that I'm about to call out is a part that really makes this very uncomfortable for me. And arguably, it is not like a smoking gun. It's more about a cultural aspect. So let me share what I mean. So when you look at the year end for their student loans, they're valuing them based on a discount rate of 3.89%. That's lower than it was last year, just by a basis point. Now, what Muddy Waters rightfully calls out, 3.89%, was 27 basis points below the 10-year U.S. Treasury yield. And this really doesn't make sense. You shouldn't be assuming for a consumer product, student loans, that the discount rate on this portfolio of loans that you're holding on your balance sheet should be lower than the risk-free U.S. Treasury rate at the same time. That is overly aggressive, in my opinion. Now, I'd once again love it if management were to say, here's why. But I think if you look at other student loan proxies, you would also see that the discount rate would suggest it should be higher, let alone the Treasury rate. I mean, it just logically, if you're looking at the U.S. Treasury rate, everything above that is going to be riskier. So you should have some sort of premium that you use to discount the portfolio you hold. And Muddy Waters saying, look, that difference just between the rate you're assuming and the 10-year U.S. Treasury yield at the time of this report produced a $247 million paper gain. That's a lot of money. So I look at that, and that does give me pause as I'm thinking about it. You could argue it's not like, hey, this company, is doing something illegal. At the end of the day, it is up to management's discretion what is the right discount rate. But when I think about valuing any of these types of companies, whether or not it's private credit or insurance or business development company or SoFi, it's important to recognize that a lot of these businesses, these financial institutions, oftentimes they are a black box. And in order to get comfortable investing in a black box, you really have to trust management. And I feel more comfortable that I can trust management when I see something like Anthony Noto's buying. So that helps. That makes me go, okay, management clearly doesn't believe they're doing anything fraudulent. That I think you can strongly say. I don't think Anthony Noto would be buying millions of dollars worth of SoFi stock if he really did believe that they were crossing the line. But he might be so in the weeds that he's missing the fact that they're not being particularly conservative. For example, that discount rate that they're using on those student loans, that, in my opinion, is aggressive. And so that does, make this too hard for me as I think about the trust required to invest in something like SoFi. I need that conservative culture. For example, there's an insurance company that the Unrivaled Nation, my subscribers know about that I'm invested in, and they've had years of favorable reserve releases where they're effectively saying, yeah, we said our expenses were going to be X dollars in the future, but you know what? The claims weren't that bad. The actual cash that we had to pay out for those claims weren't so bad. So we're favorably releasing those prior claims, favorably releasing the reserve amount. And they've had years of this. So that is the conservative culture that I like to see. And they have year after year, there's like, oh, here's a company we just sold. That's a surprising $1 billion gain. I mean, literally, they do that over and over again. I did a letter on it like 2 weeks ago, I think. That was, how they've had $2 billion just surprise gains. And that's a culture of conservatism. What I'm seeing here with SoFi, I would argue, is closer to that red line and makes me uncomfortable, is not the culture of conservatism that I would say, hey, I can sleep well at night. I want to partner with them. I like the insider buying. I like that aspect of alignment, but I don't have enough trust based on some of these things that Muddy Waters has called out. And I think rightfully so. Any bull should be able to answer this. Any bull that's going to watch this video and say, Daniel, you're just wrong. I trust Anthony Noto. How about this? Before you post that, respond with how you think of that discount rate for student loans and why it should be below the Treasury yield at the time. It's certainly way below the Treasury yield now. So I'd love to hear that argument before they're like, Daniel, you're just missing the point, and Noto I trust. And I get that. Noto's been, he's delivered so far. But the question is he pulling levers to, get to an outcome that's, makes me uncomfortable. I hope this video walking through Muddy Waters' report, talking about SoFi, has been helpful for you. If so, please make a point of hitting that thumbs up, hit that subscribe button. And if you're looking for compelling ideas, I recently did an exclusive video for my subscribers at Unrivaled for a stock that I was buying. So if you enjoyed this video, there's more like it exclusively for subscribers at unrivaledinvesting.com. Thanks so much for tuning in.